So let me give you an example that I would definitely do if this opportunity did come up. Hey everyone, it's Andrew here. So are you fully invested? Well, I'm very close, but there are still some really interesting opportunities that have been coming up. And how do you decide whether it's a good idea to reduce one investment to add to another or invest in a new idea? Well, I've thought about this for a while now, and I think I've got a good strategy that might help you tackle the same problem. All right, let's get started. Now, selling something and buying something incurs a frictional cost. And what that means is that there are a little fees involved in the transaction. So I want to keep the fees as low as possible, and rotating into a new investment really has to be significantly worth the effort, because if I am doing this all the time, these little frictional costs will just eat up my lunch. Now, I use Interactive Brokers as my platform as the fees are really low and I have access to international stocks. Yes, I know there are free commission brokers out there, but those don't give you access to the international markets. And with the link in the description, you can go and take a look at the demo account and see if you like the layout of the platform. Plus, here on my channel, I have many demonstrations of how it all works. But there are still little fees for making any trade. So if I'm going to rotate out of one position into another, I have to make sure that decision is pretty solid. And I'll take this lesson from Warren Buffett and Guy Spier, who very rarely make changes to their portfolios. I think this is smart because we need to give our ideas a chance, and if we're always chopping and changing into something, well, we think is better, well, that frictional cost will make the advantage far less than we think. Plus, how sure are we that the new thing is better than the old idea anyway? I think it needs to be really obvious. And the punch card analogy from Warren Buffett, it sums it up pretty well, where he says, most investors should invest like they have a card with 20 squares. And over their lifetime, they get to make 20 decisions. Each investment is a punch hole in the card. Now, I have probably already gone past 20 punches in my lifetime, so I'm not a good example. But that's in the past, and I'm trying to be less active. The issue I'm facing is that I'm learning more and more all the time. And what I think is a good idea now, well, my brain will evolve and I will hopefully be smarter in the future. So what I think a good idea is now, I might think isn't as good of an idea in the future. Or in some cases, there is a situation like I'm going to show you in today's video, where we find a great opportunity to rotate out of a good company, potentially into a great company, because the price of the great company is just too good to pass up. So the first part of this strategy is actually to try to do nothing as much as possible. Don't trade. Unless I really think it is obvious that I have to do it. So that leads to the next question, which is what would count as being a very obvious opportunity? So let me give you an example that I would definitely do if this opportunity did come up. Now, I own shares in a company called Redbubble. They are a small cap Australian online e-commerce marketplace company that matches customers and artists. Now, I really like this business. It is simple to understand, it is scalable, and I think it is doing most things quite well. But Etsy is a far better business. It is leaner, has a better brand, it has more things that I like compared to Redbubble. But I invested in Redbubble over Etsy because of the price. Redbubble is a bargain. Etsy, not so much of a bargain. Redbubble, I think, is a good company at a great price, and Etsy is a great company but just not even at a good price. Now, if you want to see all the companies that I follow on my watch list with up to month buy prices, fair valuations, and what I think the price appreciation potential could be, well, sign up to my e-magazine called Undervalued. I release a new version on the first Wednesday of each month. It's only $10 a month, and I hope it provides far more value for you than that. You can check out the February edition for free if you want to see what it looks like and what you can expect moving forward. There's a link in the description. Okay, now back to Redbubble and Etsy, and me thinking that Redbubble is a bargain and Etsy isn't. Well, the next question is, well, how did I come to that conclusion? Well, I had to value both companies to compare them. And let me now show you exactly what I did. So here's what I did for Redbubble's valuation. Now, I put in 15% for the growth rates based on what management think their targets are and how they've been performing in the past, and how their network effect is starting to build a little bit of momentum. 15% I think is still pretty conservative, but let's call it 15%. And that's sort of how I've done the work in understanding this business, and I feel pretty comfortable with that. Then the multiple is 20 because it's growing at 15% per annum. You should be able to sell it for 20 times. I've got the operating cash flow, shares outstanding, total cash, debt. It's in millions of Australian dollars, by the way. And I wanted to find roughly what the price actually, when I'm making this video, is around about $1.80, $1.90, somewhere around that. I think it might have last week slipped down to like $1.50 or something like that. So depending where you're watching this video, it could be at a totally different price, but you can see what I'm doing here anyway. Now I've tried to work out, well, I've tried to match this as today's price at about $1.93, and my discount rate, well, what I expect to get out of this investment if I'm buying it at $1.93 would be 25% per annum. So I think the Redbubble stock is looking at about 25% per annum from here as some sort of ballpark. Now we turn to the valuation for Etsy. Now, like I said, I think it's a better company, and even though it's a lot bigger, it's about 20 times as big, I think the growth rates are actually going to be even better than Redbubble. So I've got them at 20% for the next 10 years. Based on, well, same multiple, I pulled all the numbers to make it to compare it the same way. And the price at the moment is about $140 a share. So I'm going to get about 14% per annum here. Comparing that to Redbubble, where I think at the current price, I should get somewhere in the 20s, 25% is what I'm looking at. Etsy is not anywhere near 25%. So even though Etsy, I think, is the better company, I don't think it is worth moving my investment from Redbubble to Etsy until those ROIs become a lot closer together. For example, if the Redbubble price shot up quickly, and then I think the expected return on investment is less than, say, I don't know, 20%. And if Etsy, the valuation for Etsy maybe gets a little better, closer to 20%, well, in this case, maybe I would jump ship to the better company. If they're going to be around about that 20% range, both of them, Etsy's better. So with Redbubble at the moment looking like I could get 25% per annum as a ballpark, well, another investment would have to be pretty amazing for me to sell Redbubble and move into this. There are companies that I think are definitely better companies, but hardly any that are have high enough returns to justify selling out of Redbubble. So this is why I think finding a valuation that you are comfortable with every investment is really important. Plus, learning about the company helps a lot as well, because I have a feel for what companies I think are better than other companies. I guess something like Berkshire Hathaway is probably the #1 company in terms of quality on my watch list. So if my return on investment for Berkshire in some crazy world got up to, say, 20%, the 20% range, maybe the high 20% range, well, I might sell like half my investments and plow my money into Berkshire Hathaway. This is super unlikely, but you get the strategy now, I think. So the strategy is something like this. Over trading is bad, but rotating from good companies to great companies based on valuations, I think, is a solid strategy. So I'm interested to hear what you think. Is this logical or is this madness? Am I missing something? And before I go, I want to say a quick thanks to Dark Knight 9i9. I appreciate your comments. You asked some great questions. You are a legend. Thanks for staying to the end, and I'll see you in the next video.